Markets are rocking and rolling, they're churning and burning, they're gobbling up the shorts out there day by day, and the CPI print this morning was really just the icing on the cake. Thing of beauty. Now, it's never worth getting overly complacent, overly cocky, or confident, especially when the market is doing what you want it to do. So let's take a step back here. Let's look through all of the data points and build a logical game plan for the remainder of this week. That way we stay on the right side of the trade. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so. And stay tuned until the end of today's show. I've got 4.5. You're not mishearing me. That's 4.5 additional trade ideas to share with you at the end of the video. Let's get started here on the SPY daily time frame chart. What do we see from a trend perspective? Certainly still dealing with a daily uptrend, moving from lower left to upper right with consecutive series of daily higher lows. This has now been cemented as a set of higher lows because we know that we just produced on today's session a brand new higher high. And because we're sitting on a higher high and we know that we have all the ingredients of an uptrend, higher highs and higher lows, we can certainly afford a reasonable pullback on the SPY daily time frame and search for a daily higher low. On the hourly chart in just a moment, I'll build the case as to why I think 439.75 should be your line in the sand, but we'll get there in a moment. As we're talking about trend and pattern though, I want to point out that obviously with this higher high, giving us price acceptance to some degree over the prior top from in here, there's no opportunity for this anymore to turn into a double top, which is why I will always say it's not a double top until it is. You need to break the neckline. And there's also not an opportunity here for a lower high to turn this into a really sloppy but technically there head and shoulders pattern. Those bearish patterns are off the table. And instead what we have, and I brought this up in the Saturday video, instead of always looking for reversal patterns, what about a continuation pattern, right? Ascending triangle here. You get a break at the top of the pattern and you look for follow through. That's certainly what it's looking more like as the days continue to progress. Now, from a psychological perspective, today is also important because again, where are we getting price acceptance? Even the best location for shorts. Anyone who shorted the top in here, who had the magic crystal ball and nailed it, anybody who did the same thing here, they're now underwater. Now, it doesn't mean that all of them are going to instantly stop out all in unison at once, but the more time that passes that we're above that level, the more hot water those trades are in, the more likely it is that over time, more of them will stop out. The market is simply moving in the upward direction. Those shorts are not working. Specifically, we can get a little bit more granular and remember back to the Armageddon, big air quotes around that one, sell off from the end of day on Friday. And in the Saturday update, we basically built the case that, hey, this is just long liquidation. These are not stronger sellers potentially threatening to move the market downwards in a more substantial fashion. Look at how on Monday, we open at or slightly below the lows of Friday's session. The lower wick tests a bit lower, but we never actually interact with the key line in the sand that we talked about on Saturday at 436.75. And instead, Tuesday brings us right back up to the equal high. So now those shorts are in hot water, any momentum shorts, right? And again, today's CPI gap and hold certainly puts those shorts underwater. So nothing about the daily time frame chart structurally is bearish. Nothing about it is bearish from a psychological perspective. As a matter of fact, shorts are actually more likely to start closing out, which adds buying pressure to our market. Now, one consideration here is, is now the time for a new money long? Well, we are extended through the upper bound of the expected move here from the weekly perspective, so perhaps not. Let's take a look at the hourly chart and build a bit more of a game plan into the end of this week. First and foremost, I want to talk about what took place on Tuesday, because even if you're a non-believer of the CPI, it was cooked, it was all rigged, whatever, it's a very cynical take, but hey, I'll give it to you. Was Tuesday bullish, though? Does it still speak to buyers being in control of the market? I would 100% have to say yes. Once again, why is this? We gap up on Tuesday, we close the gap, so the sellers have an opportunity to push prices underneath 439.75. We know that to be the hammer high of last Thursday. It was the breakout on the Friday morning session that led to this rally in here, but there's no acceptance there from the sellers. And instead, we consolidate above, so any shorts who got in on momentum from the Friday session, any shorts who are thinking on Monday that this is the end of the world, we're going to see a bear flag, this thing's going to break down, those shorts don't get paid and we squeeze into the end of the day. Once again, you could take the cynical approach and say someone leaked the CPI numbers. I don't personally think that that's an appropriate take, but nonetheless, the price is printed, we produced an equal high, and from there, we got the gap, which held. So all things point to the buyers being in control, not the sellers being in control, even if you don't want to believe the CPI gap up. But the price is printed, so we have to read the chart in front of us. Obviously, when we gap up, we produce thin structure void of price action underneath us. If the sellers were going to do a better job of closing that, quote unquote, do their job, as I say, they would have closed the gap all the way. We have thin structure. There's nothing here preventing the market from moving lower. It didn't happen. So we get a partial gap close on today's session. We stay above the top of this. Once again, everything points to the buyers being more so in control than the sellers. So what's the game plan though? Are we just going to blindly long this into the remainder of this week? I would probably argue no. If you look at what happened intraday, we know the daily bar formed as an indecisive doji, and intraday we can see a lower high here. So anything that opens in range is going to be fairly difficult to trade. I don't really think that you have much of an edge in here, and obviously today's back and forth chop is kind of indicative of that. What's more appropriate is probably just thinking, can we see a pullback buy off of 444, still being a partial gap close, a little bit more of the gap closes, but we are respecting the prior double top structure from in here, right? That would be the first pullback buy to watch. And then obviously anything that goes further is looking for a gap fill reversal. 443 down to 442.50 is the sort of zone I would use. It's 50 cents. It's really not the end of the world. We're looking for hammer candles down here. We're looking for double bottoms down here. We're looking for inverted head and shoulders down here. Why is that the zone? Because it's the high of Friday, and it technically does represent the true gap close at 443. So those are the most optimistic looks for the market to participate in a beautiful long in the upward direction. Mild pullback, closes the gap, repairs some of the structure. We're looking to take out the hammer high, neckline, and then make the rotation back in the upward direction for trend continuation. That's rainbows and butterflies. If we do just see straight up continuation, very difficult to chase that type of move, especially noting that we have overhead resistance at 448.75. The risk reward in here just isn't as favorable, right? If you could pick up a long here and retarget the equal high with a stop just below, you can build the argument. You can kind of visualize how that's a much better risk reward versus like arbitrarily going long in here. Where does your stop go? Is it here? Your target's here. Now we're dealing with like 1-to-1. No good, right? So that's the optimistic take for the market into the remainder of this week. A little bit of pullback to here, reverse, gap fill reversal, as well as on the table. Now, the market wouldn't be outright bearish if we make a move to 439.75 because there's still an opportunity for a higher low here to here. Right? That is on the table, but the threat, I will concede that the threat, if this deep pullback does unfold, is something that does this, and now all of a sudden we're dealing with look above and fail. It hasn't happened yet, and obviously it will take some time to unfold if that's the sequence that is going to happen, but it's one consideration for our market. What else can I show you that builds confluence of sort of support here at 442.50? If you want to think of this as a pie in the sky double bottom, it's technically the neckline there, so that's looking real good from that perspective. If we throw on the anchored VWAPs, what you'll notice is the anchored VWAP from the second portion of the double bottom in here. It's right there. So gap fill reversal, anchored VWAP confluence, neckline of the double bottom confluence. The anchored VWAP from the head of the inverted head and shoulders from way back here is a little bit further down below. So once again, still bullish if we see that deeper pullback. The threat is just the lower high, obviously, into the future. So for the most part, buyers in control. We have confluence at the 442.50 level. This is probably a primary watch tomorrow if we start to see some downside for the gap to close. Anything from the fibs? I don't think so. I already checked them, but I just want to make sure. Yeah, the 50% retracement is a confluence at 442.50, but that's not all that killer. And then if we come from the low of the head to the top here, 38.2 is in no man's land. 50% is not really doing much for us. So overall, I think you guys know the game plan at this point. This is probably the most attractive look. This is definitely bullish, but it's hard to play in the upward direction, and we'll put our thinking cap on for a possible lower high if we get the deeper pullback to 439.75. Let's take a look at some supporting evidence. Market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's keep it very simple here. Are there any major divergences that would suggest that the buying activity is not all that impressive? And the answer is no. Volume inflows are significant on the week, up and over positive 500 million. In terms of the advanced decliner, we're all up in trend zone or just underneath it for a majority of this week, and all of the cumulative builds are in the upward direction. There's not even a worry about short squeeze here with a massive cumulative build that gets like this and then fades into the close. All of these are sustained reads into the close here, which does strike me as stronger buying activity across the duration of the session, not just initial short squeeze on the opening print. So overall internals stack up as bullish, no major divergences here. Market profile is always Exhibit B. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. I've always got you covered. For the most part, what's going on with value area and point of control from today's session? It's more centralized in today's range, but certainly don't get me wrong, it is breakaway in the upward direction as compared to Tuesday's range. I'm leaving it zoomed out so you can note that we have repaired the poor high from here and poor high from here. If you go across, was repaired, was repaired. So those are off the table as being structural deficiencies, and it may look like we have a poor high and low on today's session, but if I actually zoom in on this, what you'll notice is that we have decent excess, more of a regular shaped profile on today's session, which totally aligns with the indecisive doji that we saw on the SPY daily time frame chart. For now, though, I want to address the spike on the market profile. That's the end of day rally that we saw from Tuesday. It leaves behind this string of single prints as M period. If we do go to close the gap and there's some early acceptance, or I shouldn't say early, but just acceptance in general inside of Tuesday's range, it may not be the end of the world as long as we are above the base of that spike. And in the ES, it's 44.6550. 44.6550 may potentially provide an area of support even within Tuesday's range. I'm going to quickly flip back on over to Thinkorswim, and we can search for the same spike level on the SPY. If I was looking at this chart, it would be at 441.60. 441.60 wouldn't be ideal to go there. Again, I would still make the argument 9 times out of 10 that this is more optimistic, but that level, 441.60, may have some relevance to it just based on the spike rules coming from the market profile. What about the S&P sector performance from a weekly perspective? Certainly not the best lineup here, with energy leading the pack up 4.22%. XLB materials follows, and then we see a heavier weight risk on sector like the XLC communications. But don't get me wrong, even if you look at the XLK, it's an impressive week, up roughly 2%, right? At the bottom of the barrel, we do see the XLP for consumer staples, still green, but definitely lagging, up only 0.2%. Let's take a look at the structural charts. It starts to feel much more like rotation as we look at the structural charts. Again, do we want leadership out of the lighter weight defensive sectors? No, but we also don't want them falling off of a cliff. To me, it's like they're playing a little bit of catch up here, and once again, that's kind of that rotation which keeps market moves alive. So XLE, any threats of leadership? No. Is it breaking out of this range? Yes. Is it inflationary? Yes, but as we saw from CPI, things are moving in the right direction. Gasoline is one of the big inflation drivers. We'll see that on the table in just a moment. But for now, not worried about leadership. A very real opportunity for the XLE is to get a tag towards this trend line. This is subjective as to how you draw it in. Do you want to use the true high there? But as long as we're underneath this trend line, you could draw this in a number of ways, whatever. As long as we're underneath that, I would say for the most part, just underneath this at 87.30, and the remainder of the risk on sectors are consolidating at the highs, not overly concerned, right? So let's speed it up a little bit through the remainder of the lighter weight sectors. XLB materials, any issues with leadership? No. If you think about this range, it's moving towards the top. That's helpful. Upward pressure is upward pressure. XLC, heavier weight risk on type sector for the market. Anything concerning about this? Nope. Gap and hold. Beautiful higher low over that 64.30. We talked about that on Saturday. Good to go. XLU, it's definitely outperforming. It's towards the top of the list. Any issues from a leadership perspective? The answer is no. If this does turn into a weekly double bottom, we've got to break the neckline with acceptance over 66.80, or for those who are really diehard, it would be up here at 68. Still some ways to go before that's on the table. Let's take a look at industrials, brand new all-time high. Rocking and rolling, churning and burning. There you go. No threats. This is definitely more of a risk on type sector, just doesn't drive as much growth as compared to communications, discretionary, and the tech sector. How about financials? Perhaps the best looking chart here with the break of the ascending triangle. A thing of beauty. We talked about this on Saturday. Broke the triangle, big gap up today. We did certainly produce an inverted hammer, so there's the threat of a breakdown underneath that low to produce a pullback, but as long as we're above the breakout point at 33.65, not the end of the world. Could it be intra-week bearish pressure, intraday bearish pressure tomorrow and Friday? Certainly could be, but once again, posture-wise, it's not really jeopardizing what's unfolded thus far in the market. It would speak to strength, as a matter of fact, getting into this thin structure breakdown range. Let's take a look at real estate. Any issues here? Nothing really going on with real estate that's concerning, at least. Upward pressure is upward pressure. We've talked about inventory drying up and housing prices going up based on seasonality. No big surprises, right? Nothing crazy with these charts. XLK is one of the sectors that does potentially pose a threat, with still the opportunity for a daily lower high. I would make the argument, though, that this so far holding as a higher low with the gap and hold over Friday's high does look stronger as opposed to weaker, but we'll keep a close eye on it. Overall, once again, if we take a look at the weekly chart, we brought up this kind of exercise on the weekend update. Is it reasonable that this could turn into a big weekly bull flag and break out over the span of the next, 3-4 weeks? Certainly not an issue from a leadership perspective. 100% retracement. We've talked about all of these things. The chart looks fantastic. There's really nothing bearish to say about your XLK as a chart overall, other than just keeping a very close eye on this is a potential lower high. It's just not a threat yet. Let's take a look at the XLY. Anything going on from a discretionary perspective? Nope. Higher high, starting to close the gap. Ideally, we find support over 171, see a higher low, and get some continuation in the upward direction, even if it wants to consolidate out up here as a whole. whole, it would be neutral for the market, but it's definitely not bearish. That's the main takeaway. The sector posture is definitely not bearish. One thing that is slightly concerning is just the XLV. You need to continue to see it go sideways here. Why is that? It technically is D for defensive, we know that, but it's also the second heaviest weighted sector by market cap. We really don't want this falling underneath key support here at 129 because the risk is this doesn't really have a lot of structure until we come back down to 126.30. That would be big time headwinds for the broad market as a whole. So watching XLV, the situation where the broad market pulls back to close the gap might come from like the XLV slipping under 129, the XLK seeing a little bit of a lower high and chopping around in that range for a little while. That would be totally reasonable. And then when we look for that gap fill reversal, it's all about looking for strength then out of this, right? If the XLF pulls back under the inverted hammer low, you can kind of make the argument, or you could envision how this unfolds into the remainder of this week. Let's take a look lastly at the XLP. Anything going on from a consumer staples perspective? Not really. We're just building out a higher set of range. Is it falling off of a cliff? No. Even though it's lagging, it's certainly not producing anything here that looks overly bearish. You could make the argument that we're still dealing with bear flag. It just hasn't broken down through the lows yet. It's not really getting much love in the upward direction, but it did produce a hammer on Tuesday as the market saw that gap fill reversal, which I do like. So attempting to build out a weekly set of higher lows, again, not falling off of a cliff, not the end of the world. Here's the sector ratio grid. If you don't know how to set this one up, video tutorial in the top right-hand corner for you. For the most part, the XLK still looks like risk on, but I want to make a brief comment here that it only looks that way because we're continuously producing higher lows into this sort of wedge type pattern in here. If it starts to break down and provide lower lows, it becomes a little bit of a threat. We want to see this make a higher high sooner rather than later. It might require that the 50 SMA plays catch up, and then when these two things coincide with one another, we start to see that bounce in the upward direction. Sometimes that's just how it goes. If the XLV is D for defensive, this is not really a threat in the downward direction here. The XLF making some strides in the upward direction, but it's not out of the woods yet. It still is very much so in a downtrend out of the ratio. Need to see the firmer recapture of the 50 SMA and then a higher low be produced with then a higher high to kick off a new sequence in the upward direction. But don't get me wrong, good first steps here. Really good first steps, keeping a close eye on that. XLY certainly looks like risk on here, making a new higher high or at least equal high as of today's session. XLP looks like risk off is off. Risk off is off out of utilities. Energy is the closest one to flipping to a little bit of an uptrend here, so we'll keep an eye on it. But as we saw in the structural chart, it's not really a big threat as of right now from a leadership perspective. Let's take a look at something like our XLY over the XLP for growth versus value. Brand new higher high. Very difficult to say anything about risk off when this relationship looks this way. Overall, posture is healthy still. How does the dollar feel about all this? Certainly breaking down through the bottom end of the range here. That key support was 101, and we know that we're getting funky data from Thinkorswim. We'll see this on the 15 in just a second, but I want to point out that's a substantial break. It's not just that we're playing around in the lower 50% of the range underneath 103.50. We've actually taken out the entire bottom end of the range with this aggressive move in the downward direction. So CPI data was well received from the market. The relationship with the dollar here is making sense thus far. And if we take a look at something like a 15-minute time frame chart, you'll notice that it was we opened above, we made the attempt to see if we could bounce off the 101, we flushed through it, and there's no looking back. We closed very weak down at the lows of today's trading session out of the dollar. How does gold feel about this? If we just go back to a daily and flip this on over to the GC contract, it's certainly agreeing. So everything's playing nicely right now from an intermarket relationship perspective, with gold supporting at 1920 and the dollar breaking down underneath that 101 level. Once again, this relationship overall does speak to more bullish odds down below for equities. What about interest rates? Let's take a look at the TNX and see what's going on with the 10-year. Almost all of the breakout from this micro range, remember that this is the larger range, this was the balance on top, that big breakout has completely been undone. So we were saying that it was kind of surprising that tech didn't take a bigger beating as this breakout was unfolding. Well, with all of it being reversed, basically, now is an opportunity where if the TNX breaks underneath 38.2, we see acceptance here and then a flush into 36.40. That's kind of the key look, right? You want this to turn into a head and shoulders. That would definitely be more bullish for the tech sector, the XLK as a whole, which would speak to increased odds of bullish rotations out of equities down below. Another thing that we were looking at in the weekend update was the /ZT inverted. This is the 2-year. And one of the things that I said to keep an eye on was whether or not this gets breached and recaptured, the first reaction was negative with the inverted hammer, and we've certainly backed off of it more substantially. So we've got an equal high. We're starting to pull back. We can still hold ourselves for a higher low, but what does the Fed tracker tool have to say about this? Because remember, the 2-year is basically what the Fed funds rate mirrors. So let's take a look at that now. So the tracker tool shows us that we got slightly more confident in the 25 basis point rate hike for the next meeting, which is going to bring us to 525 to 550, but we knew that anyways. We're basically sitting at north of 90% probabilities for that July 26th meeting. The most interesting thing that took place on the release of CPI is really the November reading. So let's go on out to that tab over here. And what you'll notice is that on the day-to-day read, this is 1 day ago, this is as CPI is released, the second rate hike that was somewhat starting to be priced in for that November timeframe actually decreased in terms of probabilities, and the hold here at the 525 to 550 actually increased. You can see similar things out in the September timeframe. You'll note that you get more of a hold here versus lower odds of a hike, and the same thing for December as well. Lower odds of a hike, higher odds of a pause, but we were really concerned about the November timeframe because if we look at the probabilities tab here, it's still the most likely timeframe for that potential secondary hike to come in. So with the inflation data, it's kind of an indication that Jerome Powell's tools have been working, and maybe the lag effects will come in and start to impact markets, continue to impact markets even as we slow the pace here with one more hike and then some pauses into the remainder of this year. We may not need the second hike is what I'm getting at, and from a fundamental perspective, this market is really moving on the idea of 1 versus 2 hikes into the end of 2023. If we take a look at the fundamental calendar here, the economic calendar for the remainder of this week, we know that at 8:30 tomorrow, we will be getting the PPI readings, which I don't necessarily think will be all that market moving, especially on the heels of the CPI blowout that was this morning. Remember that annualized, we came in at 3%. Month over month, we came in at beats 0.2 on the regular and 0.2 on the core as well. The biggest driver of inflation, so here's the CPI report with the sort of detailed expenditure categories. If we scroll down, the columns we care about, by the way, are this one right here and this one right here. So last one and second one from the actual numbers. If we scroll down, food is fine. Energy it's not great, but it's certainly moving in the right direction. Gasoline is the biggest driver here, up 1% on the seasonally adjusted side. Gas services, meaning like to heat your home and whatnot, is coming down aggressively, but that's, to be expected in the summertime as we're moving towards warmer weather. If we scroll down, shelter has been a big deal, right? Sticky inflation, 0.4 on the seasonally adjusted and 0.5 on the pure reading. It steps in the right direction. I don't know if you recall, but the prior readings were north of they were around 0.7, 0.8, 0.6 is what we were getting. So we're moving in the right direction. It's not all the way there yet, but it is steps in the right direction, which is, I'm sure, is what Jerome Powell wants to see at the end of the day. This struck me as just interesting. The fact that a large driver of inflation right now is transportation services. It's not really weighted all that heavy in the actual CPI read, but motor vehicle insurance up 1.7% on the seasonally adjusted month over month. Airlines down massively, down 8.1%. Maybe it's because of all the cancellations. Anyone who's been doing any flying recently knows that it's been absolute mayhem. So anyways, that's the CPI report. It's big steps in the right direction, mainly out of services, that sticky inflation from housing. If Jerome Powell is going to be data dependent, this is what he wants to see. And the Fed tracker tool is kind of accurately pricing that in my estimation, with the lower moves we saw over here on the compare tab specific to the November timeframe, with the lower odds now of that second rate hike coming in. How's risk appetite doing? The TLT ratio, which does have some concerns based on our conversation from Saturday, did produce a lower low earlier on in this week and would classically indicate that there is a strong risk appetite for equities down below. But just remember that we want to follow that up with a look at shorter dated bonds in relationship to longer dated bonds, not equities. There was this uptick on the jobs report, Notice that it did not make a higher high. It was starting to look like it could turn into a threat, but with the CPI report coming out, most of that move has been reversed for a rotation lower and a rotation lower in here, speaking to, okay, it was just that. It was just a threat. It didn't materialize into anything more than just a threat. If we take a look at something like the HYG, all I can say is volatility. I mean, this thing is off the wall. It had a lower low. It was looking like a bearish divergence, but now we're right back up and actually produced a higher high on today's session. So take this one with a grain of salt. I would want to see something more concrete, be established here before calling for any major divergences. Right now, kind of a back burner idea with that volatility. If we just check in on Bitcoin very briefly, just want to point out that the bull flag continues to hold here now over the span of multiple weeks. It's not like it's breaking down aggressively. It's not like the BlackRock news was a sell the rip type of event, and it's holding. So does that speak to stronger or weaker risk appetite for financial markets? I would certainly say stronger. New highs versus lows kicks off the breadth indications. This has improved with the market rally that we've seen over the past couple of days, especially with the CPI gap up. That is a bullish indication. If we take a look at the SPX A200R, this is making a weekly higher high. That is also a bullish indication, confirming the strength of the rally. And perhaps the most sensitive one is the SPX A50R on a daily time frame chart. Once again, brand new higher high here, coinciding with the move that was made out of the S&P down below. That would speak to strength in my eyes. We are approaching somewhat of an overbought type situation, but it's so early in the rally. I would say in the grand scheme of things, we're not talking about like a multi-year bull market that's been going on. We're coming off of a large downdraft in 2022, where this is not, it's not a contrarian indication. It speaks to a large percentage of companies recapturing 50 SMAs all at the same time, which continues to be a bullish indication in my eyes. Let's take a look at the RSP, which is going to be the equal weight S&P 500. New higher high was produced. If I zoom in on this thing, obviously there's a case to be made for a higher low over 150 at this point in time. That does strike me as bullish. Playing catch up, we know in the grand scheme of things, there's a pretty major divergence between what's going on with this high, if you extrapolate that out, versus this high in the S&P. But in the more localized bar-to-bar type activity, it is steps in the right direction, obviously, to confirm more of the bullish nature down below. Last but certainly not least for our breadth indications is the Dow Industrials versus transports. Transports continue to rip, right? If we zoom in on this, we saw a minor pullback, continue to rip in the upward direction. Industrials have made the equal high once again. So this is a top watch into the end of this week, noting that JP Morgan, one of the larger constituents of the Dow, will be reporting Friday morning before the bell. Can we break this equal high set? Notice in here, we started to get a little bit of what looked like a double top. We were threatening that neckline, but now we're right back up at the top, turning this into bull flag. If industrials want to break out here up and over that resistance at 34,590, that would be very, very powerful for the broad market as a whole. Unfortunately, today we did produce an inverted hammer, so keeping an open mind to further consolidation and pullback, but watching this pattern very closely out of the industrials, especially with JP Morgan earnings. VIX volatility falling off of a cliff as the market made its move higher doesn't really strike me as a big concern. If we take a look at the VVIX, this is slightly concerning. The fact that the VVIX actually perked up into the close here, and it remains elevated overall in this type of range. Given the situation that we have out of equities on today's session with the gap up, I would have assumed that, especially as that gap held, some of the volatility got sucked out, and we may have closed weaker down towards the midpoint of this range. It simply wasn't the case today. So keeping a close eye on the VVIX, a concern would be if we get a big break over the 103 out of the VVIX and the VIX itself isn't responding yet, that's where you put your thinking cap on and say, okay, maybe buckle up a little bit for a harsher than expected higher low pullback to develop out of equities down below. Let's take a look at the VIX futures for all the purists out there, moving into stronger contango, reversing the move from the jobs report, getting back down to a lower low on today's session here. So this is a bullish indication. Same thing with 9 versus 30-day VIX, staying underneath the zero line, and nothing impressive out of the one-day VIX either. Volatility right now, not overly concerning. Just keep an eye on that VVIX. QQQ daily time frame chart, obviously dealing with an uptrend very similar to the S&P, higher lows, higher lows, higher lows being cemented with the equal high being produced on today's session. You'll notice that we don't have as clean of a higher high. If you want to count the upper wick, sure, but the overall price acceptance was not at a higher high. So keeping an open mind to a little bit more weakness out of the tech sector as a whole, but nonetheless, any concerns about a massive reversal? Not really. If you look at the daily time frame chart, we've held up above the top of this prior balance area. We know that to be an hourly inverted head and shoulders for our daily higher low. That does strike me as good to go. Also, the same idea of removing the threat of a double top from here with the now equal high. Could it turn into a triple top? Maybe. But once again, you've still got to get well underneath 360.75 for that to materialize as a pattern. And even at that, you would just start to count it as a balance range, right? So for the most part, daily time frame chart out of the Qs does look more bullish than bearish. We're not as far extended through the upper edge of the expected move here. We're right on it. Upper targets, just to give you a heads up, will be at 375.65 and then 380 on the upside. Let's take a look at the hourly time frame chart now and just build some conclusions and game plans over here. One thing I would point out is, again, we got a partial gap fill. So are the buyers or sellers in control? Obviously, it's going to be your buyers here. Notice also that the lower wick is precisely to the high of the Friday session. So that to me is once again a strong indication that any shorts who are getting involved in here, any shorts who are getting involved in here, no dice, got screwed into the close, closed up here, right, for a green close, unlike the S&P. So overall, QQQ looking good. Any pullbacks or consolidation that remain up here can look for the equal high break. That's a difference between the Qs and the SPY, obviously. The SPY made the higher high. We're looking for the higher high more substantially out of the QQQ. So that breakout's on the table up and over 372.75. You might want to look for some kind of like higher low pattern in here to get involved. That way you have tight risk with a stop just underneath. Pick off the entry here, and your target is that first level we just discussed at 375.65. From there, you can monitor for continuation. How's the gap fill reversal look as a trade? Certainly still going to produce an hourly higher low here off of 368.50. So that's very much so on the table. Line in the sand, at least from a spike perspective and Thursday's high perspective, is at 367.50. So a little bit of discrepancy on the downside for the QQQ, meaning that our structure is closer to disturbing the daily uptrend as compared to the SPY, but nonetheless, those are the key numbers. You can imagine that my game plan for the week looks like this, the rest of this week, right? Consolidation here, break higher low, that's the upside trade. Pulling back, looking for support here, trying to buy a higher low off of that level. We'll retarget this first and foremost, 370.25, but then it's back to the equal high at 372.75. Anything deeper than that, that's where your threat for the lower high comes in. That's where the bears build more of an edge underneath that 367.50. Let's take a quick look from a Fibonacci perspective. Let's come from here up to the high. You'll notice that your 38.2 is that line in the sand we just discussed at 367.50, so good to go from that perspective. If we come in with the fibs from here to the most recent high, lo and behold, your 38.2 keeps you in bull flag consolidation, ideal rainbows and butterflies over the Friday high, respecting today's low of day. How did the anchored VWAPs feel about the QQQ analysis thus far? If we throw those on, same concept, right? This is pretty perfect, and as we move through time, this is slowly going to play catch-up. This is slowly going to play catch-up in here. Key support. Those are playing nicely with all the data we have on the screen in front of us, so stick to that game plan until proven otherwise out of the QQQ. How do the internals feel about the move? Certainly significant volume inflows, not as substantially close to the trend higher zone, especially on the Tuesday move, which is a little bit more muted out of your QQQ in here. The cumulative ticks are all still certainly bullish, moving from lower left to upper right and sustained throughout the duration of the day. None of them are overly showing a risk of just short squeeze being the type of buyers getting involved in this market. What about market profile? This is where some pretty cool nuance comes in. I alluded to it when I was on the hourly chart talking about the spike and the Thursday high, but I guess it's just exactly that. There's no other way to say it. But 15,250 out of your NQ futures marks the base of the spike. So if we go further than the gap close, your spike base is going to provide confluence with your Thursday high, and it might be difficult to see with the white line on the chart, but there's also a point of control there, right? So all things considered, very, very interesting level there at 15,250 on the downside for a pullback out of your NQ futures. I would also point out that the NQ does have a poor high and possibly a poor low as well. Let's zoom in on that and make sure I'm not misleading you here. Okay, so not a poor low, but definitely a poor high with only one TPO of excess up there at the top. Overall, point of control and value area were slightly higher in the profile as compared to the ES. Remember, ES was more centralized. I would say that this is skewed slightly higher, but nothing that's groundbreaking there. You're going to watch your poor high here, and if we do start to close the gap, remember 15,250 on the downside spike base, and also your prior Thursday high. We already covered that as a QQQ level. Remember that that's just going to be 367.50. None other than the Russell 2000 IWM and small caps. What do we see here? Breaking out of this as a balance range. CPI massively pushes this up and over two prior resistance points, right? These are not just like, I wish I could say that these yellow lines were just marking off the gap. They were actually prior resistance points from here. We opened above this prior pivot top, and the gap started on the move up and over this prior resistance top in here as well, right? You can see that we sort of slowed down there on the Tuesday session. So all things considered, the gap is also structural on IWM. Under 190.150 closes down towards 190 even. But for the most part, we could even afford a deeper pullback than that, going towards 188.50, the top of this balance range in here. Very bullish out of the IWM with this wall-to-wall move. I was like full transparency, I was expecting some pullback off the top of the range, especially after the 100% retracement in here. The fact that we're going gap and go over the top of the range speaks to the idea that the nature of the market rally right now is broadening. We were talking about this as this breakout was unfolding back here. This put us in some turmoil, but it's resuming the broadening of the market rally with this move out of IWM more substantially from this range in here. So once again, higher low pullbacks either close the gap and give us gap fill reversal or stay above 188.50 on the daily time frame chart. We will be concerned for a look above and fail if we get a lower high underneath 188.50, but as of right now, nothing overly indicative of that. Your upper target, if we just get straight up continuation with this thing, I guess we can't say for sure. It's been wild over the past really 4 or 5 trading days. 194.50, 188.50. Certainly wouldn't expect those to be in play, and obviously we're well extended through the upper bound of the weekly expected move. Let's take a look at the hourly chart. I've already got our anchored VWAPs loaded up there. Train tracks in the upward direction, anchored from the low. Where's the tool? There it is. From the low and from the breakout move here on the Monday session. Really, really strong moves, and this is going to play confluence here. This is going to play confluence here at the gap fill reversal, right? So no matter how you slice the pie here, 190, 188.25, 188.50, those are both your key downside levels for a pullback out of the IWM. How did the internals out of IWM feel about this? Certainly okay inflows. I wouldn't call them substantial out of the IWM. Out of IWM, we want 300 million net on the week. We're approaching it. We're 290 here, but we're not quite all the way there yet. One concern is what took place on Monday. Monday really does strike me as more of a short squeeze type situation. Remember that we've been discussing this. Notice how on Monday we get a strong rally and sideways into the close. The cumulative build out of the Russell 2000 actually goes negative into the close there, and certainly not an impressive build most of the day on Tuesday. Today's session is definitely more bullish than bearish, obviously, but for the most part, kind of cautious of this Russell just getting straight up continuation. As a general market barometer, speaking to risk on versus risk off, the price, literally where prices are trading is definitely more of a risk on indication, but be open to the idea that a pullback could unfold out of IWM more so than something like your S&Ps and Nasdaq. Apple daily time frame chart kicks off our core list of companies. Notice that we have found ourselves a set of higher lows, and today's intraday hammer high break over the Tuesday high, right, did produce a solid little intraday outcome. However, look at how the daily bar closed here. No acceptance in this upper range here over 190.35. So a little bit concerning from that perspective. I wouldn't be overly bearish in Apple, though. Obviously, on the daily chart, if you just look at this trend here, you really need some solid evidence before you try to step in front of this freight train, or Superman, as we've been calling it here around the channel. And what that evidence would just be a lower high underneath 186.65. Doesn't look to be a threat, at least for tomorrow or Friday's session. We'll see into early next week. Here's the hourly chart to give you a bit more of a granular take on Apple. Anything in here is choppy. Higher lows over 190.35 start to look constructive again for the equal high at 192.50 from here. Anything underneath 189.25 can be an intraday short, but I wouldn't overstay your welcome at 286.65. Remember that the stronger convicted shorts look something like this on the daily time frame chart. Let's keep it on the hourly for Netflix, just because I think that we're doing nothing other than chopping around in a balance range. We've got to get up and over 446.50 for something more impressive to happen. Then your upper target is 457.75. Treat this as quite literally just a range divided in thirds. Upper third bullish, middle third neutral, lower third a little bit more bearish. Lower third doesn't seem to be in play, but all of these lows are very, very precise. If we test 431.50, I would expect a breakdown there because there's likely lots of stops that need to be hunted underneath, and we'll look for a little bit of a flush there. 426.75 would be the target. Next up is going to be Tesla. Tesla is best explained on the hourly, so we're going to stay here. But today did technically get a gap up, and it got a gap up into this prior range here over 275. This was looking like it could have offered a double bottom neckline break. Obviously, the gap up takes that off the table, but notice that the lower high underneath 275 puts this level back in play. What do I mean by that? It looks like with the lower high, with the lack of price acceptance back in this upper range, Tesla needs to test lower again, right? You could start to think of this as potentially a daily lower high or just a rejection of the overhead supply. So if we test lower, what's the target? Of course, it's this level once again at 269.60. I would be looking for any signs of reversal there. I wouldn't really be looking for shorts out of Tesla there. I'd be looking for buying opportunities at 269.60. And then if the market rotates higher, it's the back test of 275. And that's the trade, right? The trade is from here to here, and then you certainly reevaluate the chart at 275, noting that we've already got a rejection of the overhead supply once. For the bears to really have something going on, it's really got to be a breakdown into this range and then a lower high beneath 264.30. Here's the daily time frame chart to illustrate why. Right, there's your solid reaction on the lower wick. You've got to get some price acceptance underneath that right now. That's your daily high or low. Right, 264.30. So that's Tesla. Next up, let's take a look at Google. What's going on here? This is the daily time frame chart. I know I'm flipping back and forth a couple of times between time frames, but there is your daily lower high, potentially up against 120.15. But I would also think of this as now a failure underneath the 50 SMA, right? We got a decent hold of it here. Now we're rejecting it on the back test. Notice that as we've broken down through it, we are unable to recapture and close above it on today's session. We know that I've had a little pet peeve about Google, but if we go on down to the hourly time frame chart, we can see this building out as a flush point. So I think that the trade setup is valid. It's definitely in a downtrend. We've got lower highs. If we flush the equal lows here at 118.65, the gap has the possibility to close at 117.70. That's the trade setup I'll be watching into, like, as a scalp Thursday and Friday. But beyond that, the stronger downside moves in Google are really in here. So patience. If you're looking for a larger opportunity in Google, it's underneath 116.50. We're not quite there yet, but the ingredients are there. Daily lower highs, rejection of the 50 SMA, inverted hammer on today's bar. Here's Meta. What's going on with Zuckerberg's fantasy land? Continues to put in balance, breakout, balance, breakout. There is still some overhead gap to close. It closes up around 317. We made the move into 307.50. Is it ideal to be chasing this? Maybe with a higher low over 307.50 if this is going to be like a continuation move of this balance breakout. We've already mostly doubled the range. If you take this range and stack it on top, we're pretty much home at the target. So it requires like firm price acceptance over 307.50 for that full fulfillment into 317. That way you can place your stop underneath here. If you don't have a place to put your stop, if the market just rips on Meta right out of the gates, a little bit more difficult to trade that as an opportunity, obviously, right? The next thing that you could look for if things are going to slow down broad market wise is just a rinse and repeat of this, right? We got a break, retest to the top of the range. If we're going to get a break and a retest to the top of the range, that's 297.25 to carry forward as your key line in the sand for a daily higher low. Next up is NVDA, all-time highs back on the table, ascending triangle on the table here. If you were to draw and sketch this pattern in something like this, that is a bullish pattern. The measured move is technically this. The distance from the top to the base of the formation, and that sends us well into like blue sky uncharted territories. For the most part, I would be bullish on NVIDIA. There's really no reason to be bearish. This chart still, strong move today. Notice how we held on the pullback these prior highs. That's right here. That does strike me as a buyers in control type of move. That's just solid evidence on the screen in front of us that sellers don't really have it going on. If this was going to turn into a sharper rejection of the top of the range, you would have gotten back down into this area over here. Simply wasn't the case. So favoring upside out of NVIDIA blue sky territories overhead. Next up is Softy. A little bit confusing. Doesn't want to give us clear resolution here. So with this chop, I would say it's more similar to Google, looking for the flush of the gap close there, and then you're going to be testing 332.90 as the gap close. Could that turn into a double bottom neckline retest? Possibly. Could it turn into a daily higher low in here? Possibly. So be open to the idea of what may take place at 332.90. I would say that this has been neutral for quite some time, so expectations are quite low until we can do something more concrete like this or concrete like this, right? So expectations are low out of Softy. Next up, last but not least, Amazon, the mini beast. Balance range, balance rules, very similar to Netflix. 1, 2, and 3. We're in number 1, maintain more of a bullish edge. Looking for a break over 130, 130. We know we have some gap to close. Up towards 134, that's your upside. Ideally, it's consolidation over 129.75 for that outcome to remain on the table for the remainder of this week. Anything in here is exactly that, choppy and sideways. So now it's time to get into those 4.5 trade ideas, and then I'm sending you on your way. Hopefully you can go enjoy your evening, get some ice cream, a nice cold dessert for this hot summer day. But Roblox is up first. This is still a reminder idea. Remember that we've been talking about 42 for quite some time. If you missed the breakout over 42, we've got an inside hammer being produced on today's session, and that lower wick to the T basically goes in for the retest of 42, then closes back up towards the upper third of the day's range. So if we can take out today's high, the target over time wants to be up towards 47. Overall, trading for bullish outcomes in Roblox with this break and retest underway. Let's take a look at RIVN up next. RIVN is the ticker there, and understand that this is undergoing a squeeze, but also understand the massive context on the weekly chart that the trend here is not your friend out of RIVN. Could it continue to short squeeze in the upward direction? Yes, but just again, fully understand that that's the context you're getting involved in. Very, very risky play here, but I like the psychology of the bar that was produced today, right? We open inside the prior day's range. The prior day is an inside bar from the red doji. We take out the inside bar low. There's no follow through from the sellers, and instead we've closed up and over the inside bar high. That is a pretty bullish indication to me, and I'm looking for any follow through up and over the top of this pattern closer to 26. If that happens, I don't necessarily have a target for you. I'm just looking for the squeeze to continue, possibly a second leg out of the squeeze, keeping an eye on Rivian, but managing expectations 100% based on those weekly time frame trends, right? Next up is AMD. Honorable mention to AM Dizzle making a reappearance in tonight's show. If you take a look at what's going on here, possibility possibility for a higher low double bottom respecting the 50 SMA on the daily time frame chart. You can imagine how over time this starts to present the idea up and over 116.50. So watching that closely out of AMD, just like every other trade, there's a number of ways to get involved. If you're a breakout trader, you're looking to enter there. If you're a pullback trader, you're looking for the higher low above 116.50 once the break has already taken place. Next up, let's talk about PYPL. What's going on with PayPal? This was setting up as, in my eyes, more so a double top in here as of Friday's close last week. But with the market rallying, obviously that's not the case. So cup and handle has panned out. And now what's the idea? Well, with the red bar from today's session, looking to see if we can get a pullback. And what's the idea? Retest buy. Retest buy at 69 basically out of PayPal for the break and retest. And if we can pick off an entry here, could be a hammer candle, could be a double bottom intraday, could be an inverted head and shoulders. We're looking for that retracement to close the overhead gap, which is going to be closer to 74.85 over time. Looking for bullish outcomes, 200 SMA would be a target. Now, what's the 0.5 trade idea? It's just the same concept, but over on SQ. So I didn't want to count it as a full, totally separate trade idea, but here's your cup and handle. Right, there's your break. Here's your potential retest. Over 67.21 is looking good. We don't necessarily have a gap to close. We actually closed it on today's session, but your next overhead target would be up towards 77.50 out of SQ. So that's your 4.5 PayPal SQ combo. Same idea, two different tickers. That's going to wrap up today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a simple thumbs up. And with that said, I hope to see you in the pre-market prep tomorrow and Friday. Have a green trading week.